Budget 2010 brought to you by Harith Fund Managers.
In studio, George Glynos, Simon Brown, Pierre de Klerk, thank you very much. And later in the show, we'll be joined by Roux, Head of Fixed Income at Investec Asset Management, and Maureen Mashiani, Economist at the PIC. Very quickly, let's start with what we're seeing on the market front there, and particularly on the dollar rand. We're at 7.59. At the beginning of the speech, we were at 7.68, but of course, we have seen the US dollar pulling back considerably. So how much of this, and perhaps you can give us a view, Simon, is related directly to the South African budget?
We were moving a bit stronger already today, but really it was budget. You look at that graph we saw a moment ago, plodding along, and then there's just a cliff face, and that cliff face was quite simple. Budget speech got released, everyone went for the inflation targeting story, and Praveen Gordhan says quite clearly, inflation target 3 to 6% remains in place. And at that point, the rand just strengthened, 8 cents, went lower and kind of pulled back to around the 59.60 level, and seems comfortable there for now.
So clearly no intervention in the local currency going forward.
Yeah, we were always doubtful that there was all that much that they could do to manipulate and control the rand. As it turns out, they're going to do nothing. So I think that being the case, markets probably priced themselves for the potential of some nasty surprise, which didn't materialize. And of course, that certainly helped boost the rand. I think the positive response in the bond market as well, probably helping to boost the rand as well, if one interprets that to imply potential inflows into bonds.
Let's listen to that detail around the South African rand from Finance Minister Praveen Gordhan.
Stable and competitive real exchange rate, though in today's world this cannot be translated into a straightforward fixed price of the rand. Government is concerned that at certain times rapid capital inflows that may be required to sustain investment spending have the unintended consequence of appreciating the currency. We have therefore agreed with the Reserve Bank that we will continue to take steps to counter the volatility of the exchange rate and to lean against the wind, as it is said, during periods of rapid capital inflows, including reserve accumulation and further exchange control reform. Long-term efforts to support the competitiveness of the real exchange rate include lower wage inflation, lower budget deficits, larger reserves, and a more flexible and dynamic economy. Unfortunately, there is no silver bullet in the pursuit of greater competitiveness.
The market potentially heaving a sigh of relief that we aren't seeing any change to the South African Reserve Bank's current inflation targeting mandate. Pierre, your thoughts?
Yes, definitely. I think the market is sighing a sigh of relief, or having a sigh of relief. We didn't really think it would happen. Obviously, there was speculation about that and even about a peg in the rand. But it's good that he confirmed that the rand will be allowed to float freely, but that the normal procedure will be followed to lean against the wind, so to speak, to build our reserves currently at $40 billion US dollars. But that bit that he said in the end, that really the sound economic fundamentals into the long-term future is what will have to keep the rand at the right levels to stimulate growth.
The Minister did also add that the South African Reserve Bank must take into consideration the South African economy in its inflation targeting process. Can you read anything else into that?
No, I think they've been doing that already. So there's nothing new for me in that at all. In fact, if you have a look at the mandate as stipulated on the Reserve Bank website, they talk about promoting growth in the South African economy through a stable price environment. So that growth focus has been there the whole time. And to believe that the Reserve Bank is taking a lot of these decisions without any focus on growth, I think would be naive.
Budget deficit projected at 7.3% for 2009-2010, below expectations of 7.6%, but perhaps more importantly, throwing forward to 2010-2011, 6.2%, and then by 2012-2013, the deficit should be 4.1%. And it was always that forward-looking element that was going to be key to the market. Bonds are rallying on the back of this news.
Yeah, I mean, they're rallying really because of the 7.3, because the 6.2 and the 5.0 is unchanged on last year. The 4.1, I would have hoped that we were back into at least the mid-threes by 2013. But, perhaps they're just being a little bit cautious on that front. But bonds certainly rallying to the 7.3, because that versus what the market was pricing in of around 7.8 is quite a lot better.
Your comments on the budget deficit, a positive surprise?
A positive surprise, and as George said now, in the immediate, that number better than expected, but I think the focus was very much in the 7.3. I'm with George, 4.1 back in 2012, 2013. I would have liked 3.5 or there's about. So there's a bit of a headache out there, but in the immediate, the market is saying this is at least 0.5%, 50 points better than we expected, and really pushing it on the short-term news.
Still on the economy, Pierre, GDP forecasts of 2.3%, pretty much in line with expectations, maybe on the lower side.
Yes.
That's projected for 2010, but increasing to 3.6% in 2012. Is that a relatively conservative number in your book?
I think it is. I think that's an important thing to understand, that the Treasury has been quite conservative. Last year in October, they estimated 1.5% GDP growth. Clearly, that was very conservative. Now it's going up to 2.3. 2.6 was really the market consensus, and I think it's still on the conservative side. So in all the numbers that I mentioned, especially the longer term numbers, there's great uncertainty, and maybe they're being cautious to the downside.
South African Finance Minister Pravin Gordhan on South African growth.
Domestically, after 5 years of strong growth, during which about 2 million jobs were created, our economy shrank to an estimated 1.8% last year. Mining output fell by about 7%, manufacturing by over 12%. Consumption and private investment contracted. About 900,000 people, as we know, lost their jobs. Members of the House will recall that in October last year, in tabling the medium-term budget policy statement, I indicated that recovery from this deterioration will be slow and uneven. We projected that growth this year would be just 1.5%. We've got some better news for you. However, things are looking slightly better. Our growth expectations for 2010 is now 2.3%, rising to 3.6% in 2012.
Joining us now, Andre Roux, Head of Fixed Income at Investec Asset Management in Cape Town. Thank you very much for joining us. Andre, your preview of Budget 2010, is this a good one in your book?
Yes, a very, very predictable budget. There are very few surprises in it. But I think he struck the compromises, the balance reasonably well. It is a difficult budget. There's no question. If you look at the details on the expenditure side, it's a tough budget. But I don't think he had any choice.
The key takeaway for you in the fixed income environment, what would that be?
Well, I think that broadly the big test for governments over the next 3 years is just going to be how they handle the consequences of the global slowdown for the finances of governments around the world. That's what's played out in Greece, and a similar challenge is playing out in South Africa. Not on the same scale, not the same nature, but it's the same sort of problem. And I think what the Minister showed today is a determination to bring our deficit down in a modest and moderate and sensible manner. He's not going to strangle the economy in the process, but nevertheless, at the same time, he showed that he is willing to reduce what is a very large deficit and an unsustainable deficit position. He's going to do something about that. And I think that's heartening for the fixed income market. One or two little points of discomfort. They've introduced two new fixed income instruments, both very long maturities, and that tends to put a little bit of unnecessary pressure, in our view, on long-term interest rates. But that's a minor thing.